Hi, good day. This is Jim Kruzan, and welcome to the fourth quarter capital market review for Kaydan Wealth Management. A lot has happened this past year, and we'd like to unfold and unpack some of that to really give you a better idea as to where we see things and maybe why we're doing what we're doing still with respect to these portfolios. As we've done since we launched this series many, many years ago, we come up with a quarterly theme, which best describes kind of the environment, the sentiment, etc. And lately, I've been trying to find song titles that best reflect how we're feeling as well. And I happened upon this song from the Kinks called Tired of Waiting. I'm tired of waiting, so tired of waiting, so tired of waiting for you. And it pretty much sums up everything. I'm tired of waiting for this recession, where the data still suggests it's coming. You're tired of waiting. I think a lot of people are just simply tired of waiting. Why we do this? Well, the economy matters. At the end of the day, the economy dictates what's happening. The markets, which are really a betting machine, will go up or down in the near term, regardless of what the underpinnings of the economy are. But eventually, they all square off, and the economy tends to set the tone. So we want to explore things like the growth rate, jobs, profits, inflation, and the interest rates, and certainly where we see things. We do this in an attempt to identify kind of where we are, and more importantly, where we're heading. And to do that accurately, to provide some benefit for doing it, we need to have a pretty good idea as to where we are in terms of the economic cycle. Is this a new recovery, new bull market ahead? Or is this an aging economy and we're getting close to a recession? And also, we need to know where the Fed is, because, as I've said many times, it's omnipotent. It'll take a perfectly good economy and slow it, and it'll also take a perfectly bad economy and stimulate. We saw the incredible stimulus through COVID that we're beginning to see the effects of as it's all put now in reverse. Our agenda is it's long, although the capital market review will be short. We're going to touch on 6 different topics very briefly on the market, kind of last year in review. We want to talk about some of the economic drivers. We want to talk about finances as it relates to the Fed and the consumer. I want to make a point on the banking system from the standpoint of, here are some concerns that we have as we look into 2024, and then look at some of the traditional predictors of recessions and why those things are still somewhat problematic, and why they're not necessarily saying, hey, party on. And then what's next, or what could we see unfold, and how do we plan on adjusting portfolios as a result of that? Before I continue, I want to apologize. I've got this nagging cough from a cold I had several weeks ago, and I just can't get rid of this thing. So I'm equipped with water, and I've got a couple of Ricolas, and hopefully Danielle is really, really good about editing out the coughing. But if you hear some of this along the way, I do apologize. So let's get right into it and talk about the markets, and in particular, the market as it was last year. Last year was really a surprisingly strong year. Just about everybody, ourselves included, were expecting a recession. We continued expecting a recession just because the data suggested it. But just about every economist was expecting a recession mid-year or so. If you missed all last year, were asleep, and woke up at the end of the year, you'd say, my, what an incredibly strong market it was. I think last year will certainly be noted as a year where the market didn't necessarily reflect the general health of the economy, or what we expect the general health of the economy to be. But just the same, last year, as you can see from the far left chart, the top 10 companies in the S&P, the Magnificent Seven and another 3, were up over 62%. Now, that dragged the S&P up 24%. And the rest of the S&P, the other simply 490 stocks, were up about 8%. But it really tells another story as well. Through the beginning of November, I mean, after 9/12 of the year was behind us, the bulk of the markets were negative on the year. The Dow, the Russell 2000, the equally weighted S&P were all negative going into November and December. And then we saw a big GDP print, which was rearview mirror. And then we also saw that inflation came down a bit. And the whole expectation is the Fed is done. They're going to start cutting interest rates and things will be great. And then in December, the Fed pivoted a bit. And everybody thought the pivot was because of the victory lap that inflation is no longer an issue. It may very well be sending a message that the Fed is now planning on cutting, but maybe not so much because job well done. It might very well be because what was in the beige book and the general weakness that we're beginning to see with respect to the economy. The market didn't view it that way. We saw a huge ramp up. But when you consider the end of the year and the Dow was up double digits and the Russell was up, almost all of that happened the last 2 months of the year. That concentration of performance over a relatively short period of time is unusual and not typically indicative of a great market. What's also interesting is you can see from the box on the left-hand side that the return or the performance of the market last year, those top 10 represented 86% of the return of the market. The bottom right-hand chart said that those 10 represented 23% of corporate earnings, meaning there was a very concentrated bit of earnings, and that 23% of earnings essentially drove 86% of growth. Very, very narrow, even more narrow than it was during the dot-com bubble burst. So we would rather see a more healthy market, which would be an indication of a broadening out. While 10 business days, as it is so far, does not a market make, we're certainly not seeing a broadening out. In fact, many of the areas that rallied at the end of the year are now rolling back. We had a huge gain in 20-year treasuries. Those are down. We had a huge gain in the Russell. The last 2 months of the year, it was up over 25%. It's already down 3%, and it's continuing to show weakness. We're not seeing that continuation of broadening out. So it's something to keep in mind, something that we're certainly watching. If we were to look at the economic drivers, the most important takeaway on this is it's really all about consumers and consumption. Although government spending is quite a bit higher than what we typically see. Consumers represent 60 to 70% of the economy and currently closer to 70%. And last year, there was quite a bit of consumer activity. We had a lot of people who were still spending checks. We began the year with a whole lot more money left over from the COVID days. And we've also seen consumers with revenge spending, revenge travel. That was earlier in the year. And now we're beginning to see those things are starting to roll over. And we'll talk about that a little bit. So as the consumer goes, so kind of goes the economy. So we have to keep that in mind. When you look at the robust growth that we had in GDP last year, it was also somewhat unusual. If you look at the 3 quarters of last year, in fact, you could even look at the 4th quarter of 2022, a large amount of GDP came directly from government spending. And in fact, we are running quite a large deficit. We'll see that in a moment. And there's some breaking news as of today for the 1st quarter, where we are in terms of government spending or deficit. And it's exploding. We'll talk about that as well. If we want to see the health of government finances, the health of consumer finances, it sort of looks like this. And this is also sort of weird. So if we look at the left-hand side, it talks about the federal budget, and you can see where we spend money. Right now, interest alone is 11% of our budget, consider that like our household budget. Defense is 13%, and it's projected that by the end of this year, interest expense will exceed defense spending. That's certainly problematic. You'll also see that well over 44% of our spending is simply Social Security and Medicare. Those things are really hard to shrink, hard to rebalance, hard to tighten belt. The other thing is right now, debt to GDP, depending on who you talk to, is somewhere between 100 and 120%. Currently, it's forecasting at well over 120%. That's really problematic. So the last time, back in 1980, we had this kind of a raise in interest rates, this kind of an inflationary environment. The debt to GDP ratio was only 30%. So the debt load, rising interest rates, the effect of that on consumers certainly will have an impact. And then the other thing to see, again, with the left-hand chart, but the second column is last year, in spite of how wonderful the economy was, we ran a $1.7 trillion deficit, which is huge. And it's even larger considering we did it with growing GDP. That's something you typically don't see. You see deficits when GDP is contracting because it's one of the tools to bail us out. To run that, we're sort of inflating the economic growth, and most of the growth, new jobs created, came from U.S. government, as well as the healthcare area, which to a large degree is also government spend. If we look at consumers' finances, we're beginning to see some degree of weakness. On the left-hand side, those same things where their assets are. Remember, the markets were up generally, so those who weren't conservative, those who suffered a big loss in 22, got some of that back in 23, so their assets are up a bit. But in terms of liabilities, 2/3 of their liability is typically mortgage, and those mortgage rates are controllable. They're 3+%, unless there's a dislocation and a need to move, trade up, trade down, whatever the case is. But you'll see revolving debt, auto loans, student loans, and we're beginning to see some issues there. On the right-hand side, at the very bottom, you'll see flows into early delinquencies, and you'll notice that there's been a sizable uptick in both 30-day delinquencies in autos and credit cards. And those percentages you are looking at, 7.4% or 8%, are the percentage of total loans out there. So 7.5% of all auto loans are 30+ days in delinquency. 8% of all credit cards are now 30+ days in delinquency. We expect that number to go higher because you're not really seeing any delinquency yet on student loans, because students have only recently been required to make payments, and the current administration has also pushed the runway out an additional year. This year that we're in now, right up to just before the election, in the event that you aren't making those payments, it won't have a negative effect on your credit. More than likely, the payments get added to the back end, but it won't ding your credit rating. So right now, about 60% of all those students who are required to make student loans are not, and only about 40% are. But as that number continues to increase, it'll create some additional pressure. It'll create some narrowing of discretionary cash flow, and more than likely, you'll see those numbers begin to rise even more so than what's being reported currently. Hey, one other point about that is where we look at the rates today, and I know you can look back in the past and say, oh, they were higher. Well, yeah, they were certainly higher in 2009 when we were in the middle of a recession. But if you look at where the rates were before we went into the recession, they're comparable to where we are today. So just again, rising rates has a problem in terms of recession, which then causes the rates to raise even higher still. Labor market has been really strong. We're beginning to see some weakness there. The JOLTS report, which comes out every month, which is job open labor turnover, generally talks about how easy it is to get a new job, how easy it is to quit before getting hired again. And as job openings increase and it outweighs labor turnover, the graph goes higher. And as it reverses and there's more layoffs as opposed to job opens, the graph goes down. And you'll see there's been a fairly sizable decay in those numbers in the last year plus. Quits rate is also rolling over. We don't have people so bold as to quit before getting a new job. There was a lot of that in 2000, early 2001. And you're beginning to see the layoff numbers start to increase. Just this week alone, BlackRock, Amazon, EGADs, there are about 5 or 6 companies that I wrote down. I don't have the notes in front of me. I'm sorry. That just announced in the last 48 hours additional layoffs. And again, that's what you see early in a recessionary cycle. The dashboard, the heat map, which is that funny looking colored mosaic at the bottom of your screen, you'll see where it was primarily all green 2 years ago. The labor market was really tight. People were tripping over each other with bonuses and such just to hire someone. Not so much today. Those numbers have gone from green to yellow. We're beginning to see some autumn colors, some pink on the way back to red if the trend continues. The point I wanted to make about banking is, banks have some real issues. A lot of bank assets have left to go to traditional money markets. Less bank assets means that there's less money to lend. There's a lot less money to lend simply because of the yield curve as well. So you'll see the chart to the right at the bottom. You'll see generally where bank deposits have dropped quite a bit over the last, say, year and a half as interest rates have risen. The chart to the right is important because it's really the tale of two types of banks. In this country, we have 4,500 banks. If we identify the top 25 versus everyone else, you'll see a completely different type of mix in terms of their business profile. With those smaller banks, those outside of the top 25, almost half of their business, almost half of their loan book is commercial real estate. And commercial real estate is expected to be the next shoe that drops, as large commercial real estate is not the same as it was 3, 4, 5 years ago, as a lot of the suites are empty. People are working from home. There's less rent coming in because there's less leases, and business building values have dropped by 30 or 40%. So as these owners need to refi, because the average commercial real estate loan is 5 years in length and it needs to roll over. And we have $1.7 trillion of these loans coming due that term out that need to be refinanced over the course of the next 2 years. They're coming to the table with less collateral, less business value, less cash flow coming in. And that becomes a really big problem for many of these banks. So we'll see how that works out over the course of the year or so. Bank problem averted spring of last year. We'll see how it gets averted again this year. The bank term window that was opened last year to support some of these banks, and banks have been using it throughout. That window closes March of this year. And all those loans are supposed to be paid off. All the collateral that was given is to be returned. More than likely, it gets extended. If we look at this chart from ClearBridge, You'll see currently through December, this was just published a week ago, um, everything is red or yellow. Either it's weakening or it's just flat out bad. There's also some seasonality. Interest rates in December dropped. They're starting to rise a little bit now. Again, a lot of that was enthusiasm that the Fed's going to cut. The market thinks 6 times. The Fed was saying maybe 3, if that. So we'll see. But the credit spread improved a little bit because interest rates dropped. Also, you saw a little bit of an improvement in retail sales. The number was, I think, 3+% increase, but that was not inflation adjusted. So it was somewhat flat, but it was better than expected. But these numbers they bounce around a little bit. The big takeaway, though, is anytime you get to a point where you first see 7 red X's, 7 out of 12, and the overall signal becomes red, generally you see signs of recession, entering a recession in and around 12 months later. We're just beyond that. And one can argue, well, maybe the runway takes a bit longer, certainly because of a lot of the government spending that you typically don't see, and maybe because of some of the residual assets that may be left in the system from the COVID days when money rained down from on high. One of the key predictors of recession has a unblemished track record is the LEI, which stands for Leading Economic Index. It's published by one firm, the Conference Board. And you'll see where it is today. That's the blue line to the far right. And you'll see it's down about 8%. In fact, the headline said LEI for the US market fell again in November. This was published the week of Christmas. And it noticed that it's hovering around a -8%. Historically, whenever the LEI drops to -4.5, without exception, never fail, eventually it gets certified as a recession. Unfortunately, the group that certifies these things typically do it after the fact. You'll see 3 recessions. Those are those gray shaded bars, those vertical bars. And if you look at the Great Recession, which ran from 07 through the first quarter or so of 09, it wasn't until February, I think, of 09 that it was even certified. And then it was certified retroactive. So more than likely, if we do go into a recession, it'll include this drop as well. Once again, fairly predictive. Now, if we think about this for a second, from a longer historical perspective, this shows 9 recessions, the last 9, going all the way back to 1959. And it shows the LEI and how it improves over time. It grows over time. The economy gets better over time. But it has these drops periodically. And you'll see the gray shaded bars. And again, if we discount COVID, which was event driven, and we look at the last policy driven recession, it was the financial crisis. And you'll see the degree to which the LEI has dropped here recently, which is sizable. And if you compare that drop to all the other recessions we've had in the past, 9 of them, in 8 of 9 cases, the drop currently is larger than the drops we've seen previously. So that's something to consider. Now, the Fed is hoping for a soft landing. Historically, going into every recession, they hope for a soft landing. They never say, we think a recession's coming. And you'll see that in a moment. Janet Yellen certainly doesn't. She didn't in 08. She didn't in 01. She isn't today. But they did orchestrate a soft landing, arguably one in the last, I think, 75 years. And that would have been 1997. And if you look on the chart and look at 1997, you will in fact see a dip ever so slightly in the LEI, but no recession. And that is their victory lap. Now, if you look at the drop and decay in the LEI in 1997, and you look at the drop and decay in the LEI currently, I have a really hard time squaring these off and saying, oh, one in the same. I see why we expect this to be different this time. Moreover, in 1997, we didn't have the inflation issues that we had presently. We didn't see a huge increase in interest rates from a 0 basis. And also, on top of that, the the amount of debt nationally to GDP was much lower than where we are today. And then the inset will suggest why we are remaining defensive. Because every single month, the last 20 months, the LEI has gotten weaker than the month before. All the while the market's going up, chasing Mega 7, chasing whatever, expectation that we're going to get this soft landing and the market is pricing accordingly. Everything is suggesting not so fast, Will Robinson. So we're watching and we're maintaining a more defensive posture. I want to talk about the yield curve for a second, because this has also been a huge predictor without fail. Inverted yield curve yields a recession. Never had an inverted yield curve without a recession. So what's an inverted yield curve? Well, this chart, if you look at the bottom, identified as December of 2021, that's a healthy yield curve. Interest rates are lower at the front end and they're longer at the back end. Think of it as you're going to lend money to somebody. If you're lending money overnight, you might ask for an itty bitty bit of interest. If you're lending money to them for 10 years, you're going to want more, because there's a longer period of time for bad things to happen. And that's how banks operate. They borrow money from the government at the short end and they lend at the long end. Every once in a while, the yield curve inverts. That indicates problems. Right now, through December of last year, in spite of the fact that interest rates dropped, the yield curve has inverted even greater than it did just a year before. Now, here's the thing about yield curves. They're very predictive, as I said before, but typically the yield curve only remains inverted for a couple of months. And then the Fed typically cuts interest rates. They couldn't do it this time because, unlike many of the recessions we've had in the past, or many of the inversions we've had in the past, we didn't have to deal with the inflation rate that we had. So the Fed hasn't cut rates. They've kept rates longer, and they still are biased to keeping rates longer, higher. So historically, rates stay inverted for only about 2 months. And then when they go back to normal, about 14 months or so on average, after they originally inverted, we get a recession. But at that point, the Fed's been now cutting rates and we still get a recession. There have only been a few periods of time when the inverted yield curve has stayed inverted for well longer than 2 months. Currently, it's been inverted for well over a year, measurably longer than a year. And if it stays inverted through February, through the middle of February, it'll be the longest inversion in history. And there's an interesting correlation between inversion and the severity of the landing, hard or soft. And it seems like the longer the inversion, the harder the landing. And you can think about it, because when you have a yield curve like this, the banks aren't really interested in lending money. Their profit margin isn't what it usually is. So you get a reduction in credit, you get a reduction in money supply, you get a reduction in economic activity. And we usually get a recession if that's disrupted in 2 months or so. Imagine it being disrupted for 18 months. Being in that environment, it creates its own set of continual problems. I talked about the predictive nature of this yield curve and the inversion and the fact that it's predicted recessions. And you'll see in red print, it's, been very successful in predicting inversions the last 7 recessions going back 40 some years. In fact, it's been predictive even longer than that. So how you read this is this measures the 10 and 2 year interest rates, the spread between the two. Historically, in a regular normal yield curve, the 2 year rate is less than the 10 year. So the spread between the 10 and 2 would be positive, and that would be north of the red line, 0 plus 2.5 plus 5. And if it's an inverted situation, the yield on the 2 would be higher than the 10. So it'd be a negative number. So you'll see here that the vast majority of the time, the blue line, which talks about the yield spread, is above 0. It's healthy, it's normal. And on occasion, it inverts and it's below the line. And that's where we are today. And you'll see the degree to which we've been below the line and the length of time we've been below the line. And it's effectively now the second longest in history. And you'll also see every time it's dipped below the red line, we've essentially followed up by having a recession. Not every recession we've had has been a result of an inverted yield curve, but every inversion has yielded a recession. And typically the recession occurs when the yield curve normalizes, which is exactly the case here, because the Fed realizes there's a problem. They start pushing down on interest rates, and it's a bit too late. And it's always a bit too late. If we look at money supply, which is the grease upon which the economy works, actually it's credit. And I used to see pictures as a kid of these pallets of money, dollar bills, all wrapped up, huge pallets, big square pallets of all kinds of cash, all cellophaned. That's not how the Fed injects money into the system. It's not a printing press. Money is created as a result of creating debt. And debt becomes collateral upon which banks have the ability to lend more. And it's the lending and the paying off that increases and decreases cash levels. So M2 measures all cash in the system, the traditional cash that we would think of. And you can see the money supply has been falling. Now they're trying to get rid of a lot of this excess cash, which has its own issues. And you'll see over many, many years, the yield curve may have flattened, or I'm sorry, the M2 graph may have flattened a little bit, but it generally doesn't roll over as it has. So imagine having less lending, less cash in the system generally reduces economic activity. That's been supplanted a bit because of government spending, but we're beginning to see some problems with that because of the debt level, et cetera. In fact, fun fact, the only other time in history when M2 decreased, went negative, was 1933. And that wasn't a great period. Hey, that was a recession. Actually, that was the Depression. Not saying it's anything like that today, but certainly the same mechanics work. Another fun fact is there's a rule out there called the Somm rule, named for Claudia Somm, who was an economist with Federal Reserve, and she found the very predictive tool of recessions, which is if you take the unemployment rate and you look at the last 3 months average of the national unemployment rate, which is U3, and you compare that to the lowest recorded unemployment rate of the last 12 months, and the spread, the difference is more than 0.5%. Generally, you are encroaching immediately on a recession. And you'll see every time the blue line, which is that ratio, spikes above the flat line, a flat line would be less than 0.5, and it increases, immediately you see a recession. Always worked without fail. And you can see that we are now encroaching on that. The unemployment rate came out, it was 3.7. I think we had two 3.7s, one 3.9, and then the low was 3.4. So we had a 0.5% spread, but it's not off of average. So we want to look at this. This is just one more data point that generally, independent of everything else, suggests healthy or troubled economy. When speaking of unemployment, just understand that it's a lagging indicator. It's not a leading. It's generally one of the last shoes to drop. I know a lot of people are saying, hey, the economy is great. It's going to remain great because look at how wonderful labor is and how low unemployment is. Unfortunately, again, not a big predictor. This is a great chart. It shows the last 9 recessions that we've had since 1960. The gray line represents the recession. The beginning edge of the gray line, the left edge, is the beginning of the recession. The right edge is the end of the recession. And the width of the gray line is the duration of the recession. But the most important takeaway is look at the intersection of the left-hand edge of the gray bar and the purple line, which is the unemployment rate. And at the beginning of every single recession, the unemployment rate is really low. And then you get in a recession and there's a huge spike in layoffs. It's like everything is fine, everything's hunky-dory until it isn't. And then generally the unemployment rate may even spike and hit its peak shortly after the recession is over. But it certainly doesn't spike before going into a recession. So we have to keep that in mind. And then the very last chart, I pulled this just last week, this year, from the Federal Reserve. By the way, if you're interested in any of this stuff, you can go to fred.gov, and that's Federal Reserve economic data. And it's just a big storage space for all kinds of data that a lot of economists that are hired by the Fed, working at all the independent federal bank locations, publishes. And this is from the St. Louis Fed, and it shows the predictiveness of recessions, or U.S. recession probability as identified by the Federal Reserve. And I would just say, look, it's not a great track record. It's hard to tell, but where we are today, they're viewing the probability at something like 0.3. It was 0.03 4 weeks ago. But if you look at the recessions, the gray lines, and you look at where the blue line is just before the recession starts, you'll see the Fed's probability is generally not a whole heck of a lot higher than what we're reporting currently. And it's usually after the fact, after we're deep into the recession, dealing with whatever the fallout is, that the probability increases. I find, just as an aside, how interesting it was. Look at the Great Recession. The LEIs were reporting problems ahead for many months, if not a full year before everything happened. And then just before the recession started, the probability reported by the Fed was nil. And then when we saw a 50-some% drop in the market, we were in the middle of the throes of the recession. Their probability now reaches 99%. A little bit late. My grandmother would say, not the time to close the barn doors after the horses have all escaped. But they've got a consistency of doing that time and again. You'll never see the Fed or anybody from the cabinet reporting hard times ahead. Want to keep everybody happy. So it's a bit of an issue. So what's next? Well, the way I see it, there's three things that can happen to the market going forward. One is we get the recession that the LEI and a lot of the other predictive tools have been suggesting, in which case I think as it relates to the IRA accounts, we're in really great shape. We've been predicting that. We've been quite conservative. We expect to have performance that would counter a sell-off. And I'm more interested in what the return looked like or the loss looked like during the complete business cycle. Where were we at the high and the end of 2021? Where are we at the bottom? And how many of those marvels do we still have left to redeploy for recovery thereafter? And that's kind of the way we're positioned. But what if there is a soft landing? Well, at some point, we should see these LEIs that continue to identify weakness start to show some improvement and some consistency of improvement, in which case we'd be inclined to reduce some of the inverse funds that we're using as portfolio protection and increase our exposure to equities or exposure to long duration bonds or other things that should prove helpful as the economy continues to improve. To date, we've seen no improvement in the LEIs. Or maybe the market is predictive of the economy. I wouldn't look at last year's performance of the market as indicative or predictive, only because really it was the Magnificent 7 or 10 that did all the heavy lifting, and that's not predictive of anything. Although it was certainly nice to enjoy that if you had participated. But if it's a healthier environment ahead, we would certainly expect the market to broaden out. You would start seeing performance in areas that are outside of the confines of technology or the top 10 companies. We didn't see that for 10 of the 12 months. We saw a bit of that at the end of last year as the market kind of rallied into the end of the year, trying to make up for lost time. But since the beginning of the year, we haven't seen that at all. Many of those broadening out categories are not showing relative outperformance at all. So if we did see that, we'd be inclined to continue to increase in those spaces as well. So that's it. That's what it looks like. That's why we're continuing to do what we're doing. Because generally, when you see a recession that's brought about by policy issues, COVID being the biggest, a lot of this spending being another, the recessions are not anything soft. And generally, you see a large commensurate drop in the market, and not only in terms of price multiple, but profits as well. Combined, that's where you see these 30, 40, 50% drops, as we've seen in the last 3 recessions. And that's what we want to avoid, because that would be problematic and it would have an effect on retirement. So again, the 2 things we need to get right are where we are in the economic cycle and where the Fed is. And that's why we spend time doing this. That's why we spend time doing the research we do. I'd rather look at this research from independent sources. Data is important. I'd rather trust the data than listening to some talking head opine because they have a book of business that they have to support. It's really interesting that bond guys love the bond market. Tech guys love technology. And it was the same thing at the going into every other recession. Hey, that said, if you've got friends, loved ones, acquaintances that might be considering retirement, might want to look at a different way forward, one that might be over a business cycle, more predictive, we'd love to have a conversation. And we'd love to perform a second opinion, give them an idea of where we see them in terms of their retirement preparedness and what we would look at doing differently. We do have an elegant process that we take new potential clients through, exploring the possibilities. What does retirement look like? Where are you in terms of your readiness? What we would need to do to get started, and then development, execution, and review, which we call strategy and tactics. Also, if you're not already listening, I'd welcome you to take a look at our retirement engineer, which is all about a lot of different items concerning retirement, not only savings, tax reduction, Social Security, Medicare. In many cases, it's me being interviewed by our host. In other cases, it's me interviewing some expert. So it's interesting. Check it out. It's available wherever you get your podcast. And as always, if you have any questions at all, or just want to say hi, please call at 810-593-1624, or you can certainly visit us on our website. As always, thank you. Have a happy new year. We'll talk to you in about 90 days, and stay healthy.